Imagine this. Some of Hollywood's biggest stars never get their paychecks directly. Instead, they invoice studios through their own companies. Why? Because a loan-out corporation can turn a regular job into a financial power play that most people never see coming. So what exactly is a loan-out corporation, and why do so many creatives, athletes, and high-earning professionals make this move? Is it just a tax trick, or is there a real strategy behind it? Can a regular freelancer or consultant benefit from a loan-out corporation, or is this just for the rich and famous? A loan-out corporation, sometimes called a loan-out company, is a legal business entity created specifically to loan out the services of its owner to third parties, like studios, brands, or agencies. Instead of being hired as an employee, the individual sets up their own company, usually as an S corporation, C corporation, or LLC, and becomes its sole employee. Picture an actor named Jamie. Rather than signing a contract directly with a film studio, Jamie forms a loan-out corporation. The studio then hires Jamie's company, not Jamie as a person. Jamie's company pays Jamie a salary, deducts taxes and business expenses, and keeps the rest as profit. But is forming a loan-out corporation complicated? In reality, the process is similar to setting up any small business. You register your company, draft organizational documents, and get a tax ID. The biggest difference comes in how you handle contracts and payments. Why go through all this trouble? For one, a loan-out corporation can unlock enormous tax advantages. Instead of being paid as a regular employee, individuals can deduct a wider range of business expenses. Think travel, equipment, legal fees, and even retirement plan contributions. This can dramatically reduce taxable income, putting more money back in your pocket. There's another layer, liability protection. If a lawsuit comes up, for example, someone sues over a contract dispute, it's the corporation that's on the hook, not the individual. This shield can mean peace of mind, especially for those working in industries with high legal risk. Who else uses loan-out corporations beyond actors and athletes, musicians, consultants, directors, writers, and even some social media influencers use them? Anyone whose main value is their personal talent or expertise could potentially benefit. But what are the downsides? Setting up and maintaining a loan-out corporation involves extra paperwork, legal fees, and strict compliance with tax laws. If the IRS thinks the arrangement is just a way to dodge taxes, they can take a closer look. That's why it's crucial to follow the rules and work with a tax professional. So is this solution right for everyone? Not necessarily. For high earners with steady gigs, the benefits can outweigh the costs. For those just starting out or with irregular income, it might be more hassle than it's worth. The real key is to run the numbers, consider your industry, and talk to an accountant who understands the ins and outs of personal service corporations. If you're a freelancer, consultant, or creative professional, a loan-out corporation could be your shortcut to greater flexibility, major tax savings, and stronger legal protection. Because a loan-out corporation can change the way you think about work and money, the next video reveals how convertible loans can turn debt into ownership, unlocking surprising options for funding and growth that most business owners overlook. You can't afford to miss it.